Hi, in this video we will go through the risk management. So what are the strategies which somebody should adopt while using stage analysis? So we'll see some of the techniques in this video. So what is position sizing? So position sizing is something which determines how much you are willing to invest in one particular position or one particular stock. So ideally what you should do is you should allocate a certain percentage of your capital, say 5% or 2%, to each one of the trade based on the risk. So risk based positioning, where you define your position size based on how much risk you are willing to take, divide by stop loss distance. So let us say there is a stock which is breaking out and you are willing to buy the stock over here in the pullback. So what do? You keep, let's say there is obviously a stop loss order you want to keep here. So you calculate, and this is how much, let's say this is coming to be 6%. So you calculate how much you are willing to risk. So let's say you want to only lose around 1000 rupees. So you divide 1000 by the percentage stop loss below the price. So here let's take an example, 0.05. So when you divide, it comes out to be 20,000. So what do is you buy number of stocks which comes out to be like within the 20,000. So you're not going to invest more than 20,000 rupees per in this trade, because the natural stop loss is let's say 5% below the entry price, and that 5% is coming out to be let's say if you invest 20,000, then only if the stop loss gets hit, then only you will lose 1000 rupees. So if you, let's say, increase this 20,000 to 40,000, then the same stop loss will give you 2000 rupees loss if the position goes against you. So this is a very nice way to uh, calculate how much should be the position size. So it is based on the risk amount which you want to take. So let's go ahead. So what do we do if we know that we are in a advancing phase? So in advancing phase, usually the breakouts will work. So, and it is high probability that the pullbacks and breakouts will work. So usually in this step, what do you do is you increase the position size. So in the advancing phase, we look for adding the positions, adding these stocks into the existing positions. What if we are in a stage 3 kind of, there is a well defined resistance and well defined support. So in this phase we try to reduce. So let's say you have 1,000 quantity of a particular stock, so you reduce. So you sell, let's say, 500 stocks. So next time when the same level comes, you reduce it. Okay, and as soon as it breaks down, you are exiting the stock. So you should not be there in the stock or in the position when it is in the declining stage. So now the next concept is volatility based position sizing. So this is also one of the very good technique of putting stop loss. So in this stage, what do is you use ATR. So ATR is a average to range, it's an indicator. So let me show you here. So let's say we are talking about a stock, say TCS. So now let me just simplify this for you. Now we'll place one indicator, that is ATR. This is ATR indicator. So now what this ATR indicator does is it calculates the volatility of uh, the price. So how fast? So see here, if this candle is very big candle, so obviously volatility is going high. So based on this ATR, you can put the stop loss. So let's say here this is 14 and ATR multiplier is 1.2. So usually this is standard setting is 3. So what do you do is, let me just change it to 1.5. So let's say you buy the position here. This is your this thing, stop loss. So this trailing thing will give you an idea where to keep the stop loss. So let's say you buy here. So now this line becomes your stop loss. So when the price goes up, this becomes your stop loss. So when the stock goes below this, you are going to exit. Okay. So this is the based on the volatility, how far the values like going above and below. So scaling in and out. So as we have seen, stage 2 pullbacks, you are going to add the positions and you are going to scale out. You are going to sell your positions in stage 3 or early in stage 4. So how do you keep stop loss? So in accumulation phase, put the stop loss below the support level or recent low within a consolidation range. So let's say it's in a accumulation stage. So you have a, a well-defined support and resistance. So usually if you are in the position, then you should keep your stop loss below this support level. So within the range, this is the range, and you should keep your stop loss here. And you should avoid the tight stop loss, because let's say if you put a stop loss here, then the candle might come here and then it might go and hit your stop loss. In the stage 2, you can put stop loss on the 30 moving average. So whenever the well below, actually you should keep the stop loss below this 30 moving average or a well defined support. So let's say wherever you have a well defined support, you can keep your stop loss below this level. So let me draw it again, and let's say this is the moving average, 30-week moving average. So your stop loss should be either below this 30-week moving average or below this well defined support, or you can do 5% or 10% below the highest price achieved in the trend. So if you take this highest price, then below this 10% or 5%, that can be your trailing stop loss. So when the price moves up, you again increase the stop loss. In the stage 3 distribution stage, you have to put a very tight stop loss. So this is a stage 3. So in this stage you have to put a tight stop loss, because you have to protect your profits. You have already bought the stock in the stage 2 and now it is consolidating. So better you tighten your stop loss. In the declining phase, obviously, if you are short, then let me show you this. So if you are short, then your stop should be above this 30-week moving average. So now let's summarize. You can use percentage based stops. So whenever you buy, you have 5% or 10% stop loss, and then you keep trailing. ATR based stops, so let's say 2 into ATR or 1.5 into ATR, multiple of ATR. So this is volatility based stop loss. And chart based stop loss also you can use. Let's say support, well defined support and resistance, or moving average or trend line you can use. Or you can also use mental stop loss. So you don't have to actually put a stop loss in your trading broker's account, but you actually monitor, and whenever the mentally defined level comes, you just exit. So what are the common mistakes which you should avoid? So avoid placing stops in too tight volatile market. So if the market is too volatile, then you should better keep mental stop losses, otherwise your stop loss might get hit quite often. If your stop loss is already hit, then do not widen your stop loss. Okay, if it is in the mental stop loss, you have not actually placed it and it is hit, then better you take a loss, do not change your stop loss. And you can use limit orders instead of market orders. So if you put market orders, then and if there is suddenly a gap down, then there might be a very big trouble for you, because there will be a very huge slippage. The other way of risk management is diversification. So what do you do is, you do not buy only one category of asset. So let's say you buy 60% stocks, 30% bonds, you keep 10% in cash. So this way you can uh, diversify your assets. You can also diversify your sectors, so you do not get exposed to only one particular sectors. You should invest in multiple sectors. So whenever you buy, you keep note of the sectors. It should not happen that only you have IT stocks or banking stocks or energy stocks. So you can also look for the geographical diversion. So you can go for the international assets and reduce country specific risks. So you can go internationally in the international market. You can also have time based diversification, where what you do is, instead of buying all positions at once, you average out entries. So let's say when there is a consolidation happening, so you buy some stocks here, then when it breaks out, so you add some quantity over here, then when it comes for the pullback, then you add some quantity here. So this is time based diversification. So better you do this instead of going full fledged and then regretting that this breakout doesn't did not work, or the consolidation is happening for longer time. So in stage 2, you should focus on growth stocks and trending sectors, and allocate larger positions to leading assets. So assets which are leading, you should assign more money to the uh, stage 2 stocks. In stage 3, you should gradually reduce your exposure to the equity and go to the defensive sectors, or go towards the cash. Just liquidate and keep cash with you. In the declining stage, you should obviously avoid high risk assets and increase your positions like in gold or bond. Okay, so here we stop in this video. So do like, subscribe and comment if you have any questions or doubts. Thank you.